So good afternoon, everyone, and welcome to today's Fireside Chat with Jessica Richmond, Chief Executive Officer, and Lindsay Ellis, Chief Operating Officer of Sumday. I'm James West. I run the Sustainable Technologies and Clean Energy team for Evercore ISI. Sumday is a carbon accounting tool that makes carbon accounting as transparent and robust as financial accounting. Carbon accounting software is a specialized platform that helps businesses track, calculate, and manage their greenhouse gas emissions and carbon footprint, facilitate environmental reporting, sustainability goals, and compliance with emissions regulations. Jessica is the co-founder and chief executive officer. She's also a board member of Brand Tasmania, the first place branding statutory authority to be established in Australia, and worked for nearly 4 years as a commercial lawyer in Allen's international law firm. Jessica holds a Bachelor of Law degree from the University of New England and a master's degree in marketing business economics from Monash University in Australia. Lindsay Ellis is a co-founder and the chief operating officer. Before co-founding Sumday, he worked nearly 2 years as a partner at ER Advisory and as a business analyst for nearly 3 years at Grange Resources. Lindsay is a CPA and a graduate of Sustainability and Social Innovation Masters at HEC in Paris. So, Jess, Lindsay, thanks for joining me today.
Thank you.
Thanks for having us.
Pleasure. Could you share the origin story of Sumday and the company's mission, goals, and priorities?
Yeah, absolutely. So as you touched on, my background was in energy and resources law, and then I moved into commercial management at a public iron ore company, which is where we really sort of started to grapple with some of these strategies. We were looking at a hydrogen project, and that's where Lindsay and I started working together. And I guess through that process, we started to identify how difficult it is to actually forecast carbon return on investment, to get transparency over some of these numbers. And we did really enjoy that project and ended up starting our own accounting firm and consulting firm, where we were basically saying we would do outsourced CFO work, we'd do the financial work, but we would incorporate sustainability accounting as part of that. And as we did that work for a year, generally in heavy industries, mining, logistics, farming, manufacturing, we realized that for the most part, a lot of this footprinting was borderline made up. There were a lot of averages. There was a lot of lack of transparency. Getting that data in and using it to make a decision that we or the company could stand behind was really quite difficult, just because the lack of transparency largely on some of this data, and the fact that a lot of the supply chain wasn't able to provide primary data themselves. And so from there, we really said, well, we're an accounting firm. Let's find the accounting software that can help make this an extension of our clients' normal process, and let us do the accounting that we're best placed to do. And I guess through that process, what we identified was that generally you've either got very expensive software that is effectively consulting, or you've got sort of quicker calculators that we couldn't really stand behind as outsourced CFO or even as general consultants. So we wanted to look at, well, where is the pure accounting software that does carbon instead of dollars and cents? And that's what we ended up getting into and became Sumday to help the other organizations, finance teams, ESG teams, and other accounting firms make this kind of work accessible. And I guess getting to our sort of priorities and mission, it's really around democratizing access to proper carbon accounting and that transparency. It's not to say it's going to be perfectly accurate or we have some magical numbers that the rest of the world doesn't have right now. It's saying that most organizations should be able to do this, and most organizations in their supply chain should have an affordable way to do this as well.
Got it. Okay, that's very helpful. So how does Sumday ensure transparency in reporting carbon data, and what standards or protocols do you adhere to in the accounting process?
Yeah, it's a great question. So largely the foundations of Sumday as the product and a lot of our support. We've got an online academy with online courses, and most of that is generally focused on how do you do this carbon accounting process, so your inventory, to align with the GHG protocol as a global standard in this space. Obviously, we saw the ISSB standards get handed down halfway through last year. And really, no matter the jurisdiction, those frameworks are generally saying when it comes to disclosing your carbon emissions, that you'll be doing that in line with that GHG protocol. So that's really what we facilitate. And then in terms of how do we bring transparency or trust to this process,
Right.
I guess where a lot of CFOs or audit teams train with Sumday. These organizations generally come because we are really happy to be extremely transparent on the source data. So we don't sit here and say, Sumday is the most accurate tool in the world you're ever going to use. We'll say you are putting in your accounting data and the conversion factors that are turning that into a carbon equivalent. We're going to tell you what database that came from. Was CPI applied? What was the method? What is the FX impact? We're working on a release around disclosing uncertainty. So if 90% of your footprint is based on this average information, we'll tell you that and we'll shed light on that completely. So that's just a matter of running reports and exporting them to whatever format to give that clarity.
Right. Okay. And I should have mentioned this at the outset, but we have lots of listeners on the line. As you have questions, please do put them in the Q&A box, and I will get them over to Jess and Lindsay and make sure you do get your questions answered and don't listen to me ask questions the entire time. So maybe to continue on, what are the main issues of current approaches to carbon accounting, and then how do you differentiate for that?
Yeah, it's a great question. I'll let Linz jump in here as well. But I think one of the key issues with carbon accounting at the moment is there's probably just a lack of like authentic, honest conversation around how bad the data is and an acknowledgement of that generally. So when it comes to things like scope 1 and 2, where you're looking at, fuel inputs and electricity inputs, okay, to a large degree, that's not rocket science. It can be a bit of administrative hassle getting all of that data in and, going through that process, making sure it reconciles and it's auditable, sure. But on the whole, what I guess globally we're all grappling with is if we accept that a significant portion of most organizations' emissions come from those they either invest in, portcos if they're a bank or an investor, or suppliers for every other organization. Really, we need to get to this place in the world where we can access primary data from those organizations so we can make very basic informed choices around, is this organization going to contribute to a pathway towards reduction or not? And do I have other choices? If I'm buying whatever it might be, grain, have I got data that allows me to choose between 5 suppliers that could provide the same thing to actually incorporate that into my strategy? That's really sort of what we're missing. And what Sumday does is say, well, instead of just saying we'll calculate the whole thing on averages, which of course we can do, and then instead of just saying we're going to send a form out to every supplier and ask them for their data, which they don't have 90% of the time, that's just the truth, then what we say is you have to kind of contribute to that supply chain or those portcos. Learning how to fish is something we say in Australia. I teach them how to fish. And so we say, we're not only going to send you the form and ask the question, but we're going to educate your teams. We're going to say to your finance team or your ESG team, we will give you the education and the upskilling to understand what is required to do this to an audit ready standard under those global standards. We will give you access to that accounting support desk for all those edge cases and questions. And we'll give you affordable software that makes this accessible and something you can do year on year, and really lead with that education approach. And if they don't have the resources or they don't want to start upskilling, then it's saying, why would the existing accounting profession that might already be doing their financial accounting year on year for your suppliers or portcos, why would they not make that just an extension of normal accounting and reporting and incorporate that? So we onboard and upskill those people to ensure that's a frictionless service. They don't have to go out and find some professional that they've never worked with to do what should be pretty straightforward accounting. So I guess that's the key difference there.
Right.
Yeah, and I think just to like double click on that a little bit, I think at its core, we're seeing as this propagates into both the supply chains and into kind of investment portfolios of organizations, people are starting to get a lot of forms. Essentially, every single stakeholder is saying, we need carbon data from you. Can you fill out our bespoke form and provide that information back? The world that we see is essentially organizations should be doing this work once, doing it to a granular level, which is transparent and is able for those external stakeholders to interpret and use. And essentially that's just provided once and can be kind of drawn down on by the organizations that need that information for various needs across the kind of plethora of businesses that they're working with. So I think that's like a really key thing that we're trying to solve for. And at the moment, I think that process is really quite difficult for a lot of organizations, especially with a lot of stakeholders. Like you essentially have to have a whole sustainability team dedicated to responding to these requests at the moment, which is like not going to be scalable long term.
Right. Makes sense. Well, in your view, why are carbon calculators at this point really not accurate?
Yeah, so did you want to go, Jess?
You go, Lindsay. I think we have the same opinion. You go.
Getting on a bit of a roll. Yeah, so I think fundamentally, so obviously when we talk about accuracy or uncertainty within the carbon accounting process, there's kind of two main pieces, right? So there's the first bit, which is down to the emissions factors. So that's the kind of magic number that we're using to quantify emissions from various activities. And it's pretty obvious within a lot of the discussions that we've had, and maybe it's not frank enough across the industry, that in fact those averages are very high level. A lot of the time they're drawn from academic research, or in the US, a lot of there's essentially a database that's published by the US EPA. It's relatively out of date and is high level. It basically takes a cross section of the entire US economy and breaks it down into the different industries. And then that number is what's used to apply to a very broad base of activities. So fundamentally, even within an industry, there's going to be large variances in terms of the carbon intensity of their products and services. And that's not really captured within the data. So you might have an organization that's doing really great work, or for some reason has a lower say intensity of their electricity based on their investment in renewables. If that's not being picked up, essentially that's creating kind of inaccuracies within the approach, and is not and critically is not incentivizing organizations to be making those kind of investments within their organization, because they're not being recognized for them. So obviously that's a huge kind of driver for the uncertainty. And over time, hopefully we can get to a point where we start using less and less of those averages and more primary data. So that means essentially collecting that information directly from the suppliers or the portfolio companies that investors might have, and using that data in a way that can kind of incorporate into the overall GHG inventory of the organization that's preparing it. So that's really one side. And then on the other side, is the activity data side of things, or the data that's being collected within organizations. We see a lot of the time, especially for organizations that are doing carbon accounting for the first time, they might not have their accounting processes and systems set up in a way to collect that information. So if we take an example, essentially we work with even large organizations that are unable to kind of tell us exactly how much fuel that they're using within their operation. They obviously have the dollar amount going through the general ledger, but they don't necessarily track the number of liters of fuel that are consumed within their operation. So within carbon accounting, there's kind of this cascading scale of data quality with that specific information. Obviously, if you think about fuel, the price fluctuates quite a lot. And so if you're using that as the basis for carbon accounting, obviously that's going to be highly inaccurate as well. So the idea is we're looking to collect that information from organizations and try and find the most accurate information and build processes and systems that become an extension of their regular bookkeeping and accounting processes to make sure that we can kind of reduce that inaccuracy. But because it hasn't been embedded within organizations to date within their accounting and finance functions, it means that both structurally as a carbon accounting process and in terms of the business's broader accounting processes, there's a lot of uncertainty in the overall calculation, which I don't think is necessarily, I guess, talked about as candidly as we would like within the industry, I think.
Right. We have a question that's come in from the line. Let me throw this one out too. So how does Sumday calculate financed emissions?
Go for it, Linz.
Yeah, so we're working with a number of banks and financial institutions at the moment. Typically, we see most organizations that are looking to quantify their financed emissions using the PCAF standard as the kind of the baseline for that. So Sumday helps facilitate that within the platform by having categories and calculations compliant with that. But really the key thing that we're trying to do, obviously within PCAF, there's a scale of kind of data quality as well, where we're looking to either use those kind of industry averages that we've talked about to quantify the emissions of portfolio companies or borrowers, or we're looking to collect that kind of primary data to say, for the loan that I've written or the investment that I've made in that organization, can I get the actual information for that portfolio company to then feed into my overall PCAF reporting? So the idea is Sumday kind of helps in two ways. We facilitate that the portfolio company kind of reach out and engagement process. And as Jess talked about before, we teach the portfolio companies how to fish to ensure that you can essentially get in that high grade PCAF quality data from your portfolio companies. And then where that information isn't available, then we'll work with investors to then identify opportunities to fill those data gaps in the short term with PCAF compliant calculations.
Got it. Okay. And then what are some of the myths around emissions data that you think need to be addressed?
Yeah, so I think there's a couple of really key ones as part of the process. Certainly the first one that I want to call out is the role of accountants within carbon accounting. I think up until now, there's been this myth that carbon accounting is really just the place of ESG professionals and sustainability professionals internally within organizations. What we're starting to see now, and as Jess talked about, really our fundamental belief is that this is going to become an extension of financial accounting. And so accountants are going to have a really important role to play in this, both in terms of public practice accountants that are looking to facilitate and help their clients to quantify their emissions as part of the normal work that they're doing, potentially in an outsourced capacity. But critically, if you're going to embed carbon accounting in a way that's efficient and affordable for organizations, it needs to be kind of taken on board internally within some of these large corporates and to some level the mid-market organizations that we're currently working with as well. So having accountants doing the work is super important. And I think for accountants themselves, they've kind of believed this myth. So what we're really trying to do is help break that down and bust the myth for them by providing that upskilling support, and carbon accounting help desk to really help them realize that this is just accounting. There's a standard that they can follow. There's work that they can do that can really add value to the organization and feed into the existing work that they're doing. So we see that as the first key kind of myth to bust. And then I think in terms of the second one, it's around the supply chain aspect of things. Organizations, when they hear scope 3, they're like, this must be too difficult. How am I supposed to ever get information from all of my suppliers? I think the fundamental thing to understand here is the standards are aware that this at the moment is relatively difficult. Organizations have the opportunity under the standards to use several different methods. Some of them are kind of those lower quality methods that involve using proxy data. But engaging with the supply chain isn't that difficult, especially with software solutions like Sumday to support. You can reach out to them, understand if they are measuring, and if they're not, essentially provide access to support and education to help get them on their journey. I think it's critical to understand, and obviously regulators and standard setters realize that this is going to be a journey for people. So there's phasing in periods for a lot of this stuff, especially around scope 3. So organizations need to start somewhere. And I think one of the key things is starting with upskilling and realizing that this stuff isn't that difficult. You just have to be structured and methodical around collecting the data. And where it's not available, then it's really just disclosing that information. Did you have any other myths you wanted to jump on, Jess?
I think maybe just the last one is like who this is for. I think we see this across jurisdictions where, you know, it's only for the, you know, biggest companies that can possibly afford the, you know, $200,000 consulting exercise to understand a baseline. I think that that has really done a disservice to getting better quality data, because there is this assumption that unless I am going to be paying a small fortune and I bring in every consultant under the sun, this is not something that we can do. And really, it's not just Sumday saying this. I know that, various pockets of the industry have spoke about this for years. If you do make this affordable, and it isn't an enormous exercise to find the right professional consultants to do this, it's actually just the professionals you already have. This should be far more affordable and accessible. And I think people expect that it's not. And so therefore it's something we'll kick the can down the road on, rather than saying, actually, this is just risk management. Maybe there is an opportunity for us in this. It should not be difficult to go and get that information.
Right. Okay. We've had a couple more questions come in from the line. I think two very good questions. First off, do you see an issue with reporting frameworks around the world fragmenting in different jurisdictions? For example, differences in GHG calculation methodologies required in Australia or ISSB requirements versus other countries?
I can take this one if you like, Jess. Yeah, so it's definitely a key issue. I think the ISSB has been doing a good job in trying to kind of align some of those specific reporting discrepancies. It's going to create a bit of a headache. Obviously, if you think about financial accounting, we already have this to some degree in terms of US GAAP and some of the other kind of reporting requirements elsewhere in the world. And so you can see that that creates some confusion for stakeholders in terms of interpreting financial information. And the same thing is going to occur with carbon data if we're unable to kind of reconcile those differences. So as part of that, obviously regulators and standard setters need to be kind of conscious of that to try and not create this additional regulatory burden and compliance burden that I think a lot of users are kind of seeing coming down the line towards them. But if that's not the case and we can't kind of avoid that from happening, which it's looking like there's going to be some degree of differences by jurisdiction, like for example, in Australia, in terms of how we're treating electricity accounting, that's slightly different to the regulation or the standards that have been proposed by the ISSB. So there are these kind of edge case kind of differences that are emerging. And so the critical thing that happens then is that organizations, when they're disclosing their carbon information, it can't just be like a one-pager within the sustainability report. It needs to be integrated into their integrated report, and it needs to have specific disclosures around the calculation methodology. So to the extent that there are those differences that are emerging, then users of that data can actually interpret it and kind of do their own kind of comparison to help align some of those kind of differences that have emerged. But it is definitely a critical issue for organizations, and certainly there might be some organizations that have to do some kind of double work to kind of negate some of the impacts of that.
I think this is where often we say, getting the CFOs involved in this, the accounting industry involved in this becomes really key, because this isn't mind-blowingly unusual for them. That's a common. I think I'm back. Does that work?
Yes.
Yep, you're back.
Sorry about that. Yeah, getting them involved, this is like a common thing. And often when we work with large organizations that have operations in different jurisdictions, this is a common thing, because perhaps the ESG team have been usually pretty under-resourced, doing the best reporting they can. And now they're facing this compliance world where this is going in the annual report. And you often say to those people, what methodology did you adopt? Under what was the approach? And it actually hasn't been documented to that level, because it just hasn't been in their wheelhouse as something to do, or B, it hasn't been staring down the barrel of the level of scrutiny and public disclosure that what it now is. So making those disclosures and understanding it, again, is actually really normal for an accounting world.
Right. Okay. Well, the other question that's come in, and this is about kind of the broader vision for the company, is the vision to customize each firm's supplier portfolio carbon data, or to actually build a library that includes large bodies of supplier data that's now anonymous, that can be shared and that all your customers can benefit from, or is it both?
Yeah, that's such a great question. And it really gets to the vision of how we see this playing out. So as Lindsay touched on, we do not believe it makes sense or is practical for, say, let's take telecommunications. Let's take a big telco, to go to all of their suppliers, and ask for carbon data, and then go and do that again. Another telco goes and asks the same supplier. So what we do is, one, we'll go and ask their supply chain. We'll ask them to provide that primary emissions data if they are able to do that. They can use Sumday to settle their assessment. And when they go to finalise and say, yep, this is my assessment, this is my emissions factor, they get a choice to say, for everyone else that comes and uses Sumday and you show up in their supply chain, are you happy for us to give them that primary number? They can double click and come and ask you for further information, but are you happy to say that, you know, poles and wires are us equals this emissions factor? And if they do, it means we start to take away this burden of going out and getting the information and people having to answer things 1,000 things, because we distribute it. But on the other side, which that question gets to, is yes, we're collecting this primary data. So to the extent that we're able to aggregate that, obviously de-identify that, but say, look, we have 10 hotels in your jurisdiction that are carbon accounting with Sumday. This is the average of those. Is that better than a US 2012, EPA average, or whatever the alternative might be? And so again, it's us bringing transparency to say, this is what we did. This is why we think this is a good emissions factor. Use that should you wish. So that really is the vision, to have a database that we can all rely on and is accessible and affordable to start bringing deeper accuracy to this type of accounting.
It's worth calling out. Sorry, James. I was just going to say, it's worth calling out that there's some organizations that do kind of perform this kind of aggregation side of things. So the CDP is an organization that kind of collects this information. But what we see a lot of the time is, essentially using that information, interpreting it, and then bringing it back into your carbon accounting process can be relatively friction filled for a lot of organizations. So streamlining that process and being really clear in terms of where that data has come from, because we've essentially, all of the clients that are using Sumday have built that ground up kind of view of carbon accounting. So then in the disclosures, you can have a really strong understanding of how that's worked. And then you can make the choice, do I want to replace the average that I'm using, that's maybe from another source, with this new average, or do I want to be using some other kind of method to calculate it? So having the choice for users and having the transparency is really part of the vision that we're trying to build. But in order to get there, you need to obviously have the volume, which from our side of things, we see as being able to work with organizations in a cost-effective way means that more and more organizations within the mid-market who are in the supply chains and are in the portfolios of large investors and corporates is going to be critical to make this happen. Without the kind of penetration into the supply chains, the world where you can kind of have those averages that mean anything is going to be a long way away.
All right, got it. Okay. Well, maybe I'm going to give you two questions. It's kind of around the same topic, but how do you educate and engage with clients to help them understand the benefits of measuring and reporting carbon emissions? And can you maybe talk to how long it takes for this education to happen, and details about the process and the steps?
Yeah, I might let you take the ladder around working with the teams, Lindsay, but in general, this is something that we see is so critical and usually really missing. So when we go and reach out to the supply chain or the portfolio companies, really what we do is say, this isn't just for you to tick a compliance box of your customer or your investor. This is something that a lot of organizations are going to ask you for. Customers, insurers, financiers, this is kind of the world going forward. We understand that you probably don't have internal resources for this. We understand that this is probably hard to make a priority. We understand that you're worried about how expensive this is going to be. So really, we try and acknowledge that piece so that it's not this big stick, frustrating thing that they're being asked to do by the organization. And then we say, we're just going to get to the practical point here that you probably need to build some internal understanding of what is required so you can make an informed decision as to whether you're going to do this in your team internally, or you might want to get your accountants involved. And the practical side of that is they get access to what we call the Sumday Academy. So they get access to online courses they can do in their own time. And instead of just high level, what is ESG that you could YouTube tomorrow, it really is designed for a a person to go through and prepare the actual data that they need. So it steps through the standards, what are the methods, where is the data usually found. It has really practical things like an Excel-based example that they can work through. And what we usually find is it's a real aha moment for the suppliers to say, oh, I've actually never been given the practical education around this. Now I might make a decision that I'm going to have a team member do this for, 4 to 6 weeks to get across this, or I understand it. So now I'm going to make an informed decision on how much we pay and who we go to help us outsource that and get it done. But also I'm getting education around what are the benefits for my organization and what are the other ways that I might want to use this data beyond just answering a form. So really giving them access to that practical education is key. And maybe, Lindsay, if you talk through how you work with the auditors and CFOs and accountants as well, timing wise.
Yep. Yeah, that's a good segue. I think so. Obviously, it depends on the goals of the organizations, but essentially we have several long form courses that probably take around 20 to 30 hours to complete. And so that's really aimed for kind of public practice accountants or people within the organization that are actually looking to kind of do the carbon accounting work. And so they step through the program itself to kind of build that kind of foundational knowledge around carbon accounting, which is super helpful. And then we also have kind of industry specific kind of educational materials. So for finance emissions, for things like agriculture, we provide additional kind of modules to kind of cover those topics. Obviously, for some organizations, it's going to be highly relevant. For others, it's not going to be relevant at all. So we try and tailor the package around what organizations need in order to develop that kind of solid understanding of carbon accounting. So what that might mean for an organization, they might have 2 sustainability professionals and maybe 3 accountants that are kind of interested in being part of this process. They would essentially onboard with Sumday, jump into the training and start kind of working through those materials. Might take them 2 to 3 weeks to go through the process. And then at the back end of that, then they can potentially start kind of working with their own kind of data to start building out a bit of a GHG inventory themselves. So on top of the actual training within the self-service training within the product, we provide a carbon accounting help desk. So in the background, we provide the opportunity for those finance professionals and ESG professionals within organizations, but then also in some of the large accounting firms to come to us and ask us some of those gray area questions or to understand kind of where to go to find some more guidance around some of these things. So having that kind of practical bump and steer along the way allows users to start kind of working through the process quicker because they've got the guardrails to kind of know what to do. So overall, we see, over the course of a month or 2, organizations can really build a solid understanding of kind of practically how to do some of this stuff, noting that there might be kind of gaps within the skill sets of the organization, at which point then they can kind of understand what other resources they might need to pull in order to prepare a full GHG inventory. But really starting with the foundations can then inform the kind of approach to how you roll this out more broadly within the organization. I think probably the last thing to kind of call on there is really around organizations, other stakeholders within the organization. So we see, obviously, some organizations will have facilities managers or people that are ancillary to the carbon accounting process, but are the gatekeepers of that information. And so by training them and providing them with some of the relevant understanding, it means that they're collecting the right data and have the context around the work that they're doing and how that fits into the carbon accounting process. So in addition to that kind of detailed carbon accounting course that a lot of CFOs and accounting professionals will go through, we also have some more kind of, I guess, generic courses that are tailored around these other people within the organization that need to have some understanding, but might not be doing detailed carbon accounting work. So those are typically, 3 to 4 hours and really provide some context for them and allow them to kind of be more efficient in the collection and preparation of the data where it's relevant to them.
Got it. Okay. And then how do you, we talked a little bit earlier, Lindsay, on finance emissions and how you account for those. But what are your thoughts on the future of finance emissions?
Yep. Yeah, I think it's a really important question. We're seeing, obviously, the approach to finance emissions. A lot of organizations are now voluntarily reporting in their finance emissions, which is a great start. Like we talked about before, though, I think one of the key things that we're going to need over time is a convergence around both the approach on this and then the comparability of reporting. So we really see that, especially in the finance emission side of things, which has a a huge impact in terms of driving the economy in a certain direction, organizations are going to need to be kind of more forthcoming with some of that information. And typically that's going to be centered around the quality of the information that they're collecting from the borrowers and portfolio companies. So at the moment, obviously, standard setting bodies like PCAF provide a pretty solid kind of outline in terms of what types of methods are available to measure emissions and a robust kind of way to calculate data quality. But what we see, and this is kind of a bit of a light bulb moment for a lot of investors, is if they're not measuring the emissions of their portfolio companies with accuracy and collecting that primary data, likely they're not going to have a way to get to net zero or demonstrate a significant reduction in their emissions over time. If they're reliant on those industry averages, probably those numbers are going to stay relatively constant and they're not going to be able to demonstrate the reduction. So for organizations, we really see that engaging with their portfolio companies is the next kind of frontier of the financed emission side of things. So whether that's in kind of direct collaboration, like we talked about, providing the tools and resources, or collaborating with other investors within the ecosystem that have shared investments to really kind of nudge some of these portfolio companies into providing that actual primary data. Without that, investors aren't really going to be able to take into account the risks associated with climate in some of these areas, and they're not going to be able to demonstrate the reduction. So we see the future of finance emissions really centered around this collaborative approach to collect primary data, and then again, the robust side of the reporting and disclosure. Certainly there's some sectors that are going to have to move quicker than others. Oil and gas and some of these heavy polluting industries are obviously going to be at the forefront of the spotlight, but we see that's going to kind of cascade through the rest of the economy, in line with the regulations coming out and the standards in many jurisdictions as well. But yeah, certainly collaboration and transparency are really what we're going to need to be able to accurately kind of measure this and be able to kind of communicate those things to stakeholders that care.
I think we're also going to see, from I guess a legal perspective over the coming years, where if funds or financial institutions are making these claims or sharing these net zero or transition strategies, and they're being very public about that, if then when you go, and now obviously from basically this financial year, they have an obligation largely around the world to disclose their carbon data. I think those two things are going to be scrutinized so heavily into the future. How can you say this is a green fund, or it's a green loan and there's huge opportunities in that, or that you're on track for a 1.5 degree portfolio or any related claim, if you then turn to page whatever of the annual report and you look at, well, how have you calculated those emissions, and essentially it's all just averages, and next to nobody in that portfolio has provided actual information. And so what we're sort of starting to see now, even where we're working with, say, pension funds or smaller banks, where they are now saying we're nervous about that. And while we don't want to be seen to be the ones going and adding this expensive compliance burden on our portcos, right, because that has a disadvantage, they're worried about how does that customer respond, really, or that investee. What we're really starting to say to them now is, times are changing. The future of this is not going to be your choice as to whether you ask or not. So ask in a way that empowers them to get on with it for their own benefit as well, and start collecting that information.
Right. Well, a question came in from the line while you guys were talking that I think does incorporate this subject, and it's a query. If a PE investor sells an underlying company, do the emissions inventory remain with that sold asset to continue data reporting? Does it vanish into the ether again? And would the PE asset owner have a single dashboard?
Yeah, it's a great question. And obviously we're seeing kind of divestment as a really kind of key kind of topic that's emerging as things kind of change within the industry, and portfolios have different objectives now. So under the PCAF standard, essentially there's two kind of key components into calculation of financed emissions. So firstly, it's the underlying emissions associated with that asset. So if we're a forestry company, it's going to be the emissions associated with the fuel that's used by the forestry equipment and the electricity and potentially some scope 3. So you calculate the emissions associated with the portfolio company or the investment separately. And then there's what's known as an attribution factor, which is linked to the PE firm's ownership of that asset. So maybe you have an equity stake in it worth that's 10% of the overall value. And so really that attribution factor determines what amount of financed emissions is going to be relevant for the organization. So obviously if you divest, then the attribution factor is going to go to 0, and 0 times by overall emissions is going to be 0. So essentially organizations will no longer have to disclose any financed emissions associated with that asset in subsequent years. So this obviously creates some contention around kind of the treatment of this. Essentially, if it then goes kind of off balance sheet, does the company stop emitting? No, but I think this is one of the key questions that organizations and potentially PCAF itself will need to work through in terms of the specific reporting around divestment. In some ways, a lot of people see divestment as a positive thing in terms of a market signal and kind of retracting funding, but it doesn't necessarily solve the overall kind of financed emissions puzzle here, because that kind of capital is coming from elsewhere that maybe is not reporting in the same kind of rigorous way as PCAF. So to answer the original question, essentially it'll no longer be sitting with the PE fund, but typically what we see is organizations will disclose the change in ownership as part of the kind of note disclosure within their kind of integrated report or sustainability report, outlining that kind of has occurred, because obviously there'll be a drop in their overall emissions. So accounting for that and making that clear to users of that carbon related data is key, but then on an ongoing basis, they'll no longer have any kind of responsibility or like ownership for that particular investment.
Okay, great. That makes sense. And then the new owner would collect those emissions would be the obvious.
Correct. So if they bought the 10% stake, then they would have essentially the 10% kind of, I guess, reported emissions associated with that investment.
Okay. Could you share with us any success stories of maybe a client who has significantly reduced their carbon footprint using your assistance?
Yeah, I think a really interesting case study to speak to. I'll say two things first. I would speak to an interesting case study around their approach to this, and another where it's quite the opposite. So I guess a lot of organizations come to Sumday and say, we've had pressure from audit committee, or we're going to have to disclose publicly, or, there are a variety of things that are forcing us to do this properly now. We need to make sure that we're fully complying with the standards and getting on with it. And so often what happens, and Lindsay often ends up having these very interesting conversations where, in fact, when they come to Sumday, their emissions might go up 200%, because what has been happening for the last 5 years, say, since they've been reporting, is they might have been missing out key categories, or they haven't been collecting that data properly, or there might be exclusions that aren't going to stand up in a world where this is audited, or where there's a question on why was this excluded. Or often we've seen instances where that decision around materiality and whether it should be included, probably not having the rigor that you would expect in a financial accounting world. And so Lindsay has the fun job of working with a lot of CFOs or head of ESGs and explaining that since you've come across to Sumday, you're going to see this huge increase in emissions. And we're seeing that broadly across all industries, across really large organizations. And then it's a conversation around, well, actually, how do we demonstrate that this is a signal that we are doing this properly, that we have learned, we've upskilled, we've understood what this is, and we're on track to be really transparent with our stakeholders or our shareholders, and we're going to go that way. Now, there are complications often in that, because sometimes people have been paying for offsets and they've been making carbon neutral claims. Are they going to continue doing that if their emissions have gone up 200 or 300%? We don't pretend to sort of simplify and say, oh, Sumday halves your emissions overnight. We are literally sitting here going, we're going to provide you with the granular, auditable, transparent accounting software that makes you do this properly. And then obviously there are things to work through from that. So we're really honest around what that looks like. And I think genuinely it's a really good thing that we're starting to see that, and we're getting more apples to apples. But on the other side is, where have organizations come to Sumday with a real strategy in mind? So we work with a a very large gold processor. And obviously, there are opportunities in international markets at the moment to demonstrate that your product, your commodity output, is lower in emissions than what an alternative may be. And we're sort of seeing this obviously in various industries where, whether we're making EVs or whatever it is, we're sourcing materials with a lower footprint so that obviously we can demonstrate this lower emission alternative. And so they've sort of come through to Sumday. And again, we really get to the nitty gritty of that, where it's like, well, if we want to be going and sort of saying we're selling a green commodity, or we're demonstrating emission reduction, how are we justifying that claim, and what data are we using to say that, that's something we can stand behind and sell into the market? And that is often where like real opportunities sit, when you actually are confident enough to stand behind these numbers, leverage the premium, or get the contracts you might not have otherwise done. But to do that, you really need to be confident in that data. And so that gold processor has used Sumday to reach out to all of the gold mines that it has contracts with, to ask for emissions data from them. And where they haven't been able to provide it, they've said, no worries, here's Sumday who can assist you with that. Here's the education, the help desk, and getting that information in. And now they're finalizing that assessment for the first time to say, this is where we now stand. And they're looking at the emission reduction projects within their operations that are going to mean those numbers go down. But importantly, in assessing that carbon return on investment, they're now looking at a base case that they actually have confidence in, and that has been driven by far more primary data than what they would have previously.
Right. Interesting. Okay. Those are great examples. Could you maybe talk a bit about any strategic partnerships or collaborations you have, and how they've contributed to the company's growth and development?
Yeah, absolutely. So we really sort of lent in at the very beginning of Sumday around this accessibility and affordability for anyone in that supply chain to get on with this, because it's so important to that customer that they do. And so one of our earliest partnerships, this is more at an SMB level, but we did a global partnership with Xero, who sit behind as the financial accounting software of around 3 million companies globally. And so really this is on this idea that actually carbon accounting is an extension of your financial accounting. How do we integrate that data? How do we make sure that this is accessible to the company doing 10 million revenue a year as much as it is to the $1 billion public company? So that partnership has been fantastic in basically getting the accounting industry to see that they have a very clear role to play in this, and that they are the ones that can democratize access. We always like to say the local baker has an accountant, and so does BHP. So we have this mutual role in these organizations. Let's leverage and turn the lights on as Sumday for those people to contribute and get this job done. So that's been fantastic. We also partner with the accounting firms themselves. So we recently announced a partnership with Baker Tilly in the US, where again, they have considerable number of mid-market clients, many that are going to be caught by, say, the California legislation, or expect to be caught by, if there is an SEC, or if not, voluntarily. They're all facing that pressure. So now we work with them to say we've upskilled, an audit team, an outsourced CFO team, advisory team. They now, when they are working with their clients, can offer that at a far more affordable rate and accessible rate than what they would if they needed to pull in consultants from everywhere to get that job done. And so we have a number of those accounting partnerships as well.
Okay, that's very helpful. And I know I told you I'd keep you only 45 minutes. We've run over, but I have just two more questions for you. One, could you describe or outline the competitive landscape, and how does Sumday differentiate itself from the established players or the emerging startups?
Yeah, absolutely. So when we were an accounting firm, we obviously went through and looked at where will we send clients, or where will we use software to deliver this work? And we went through the competitive landscape quite extensively. So at the top of, enterprise software, we have platforms like a Watershed, or a Persephone, and they are a little probably less we're an accounting product and more we essentially do a fair bit of the consulting to support you in preparing that assessment. So what we found is that our clients generally did not have an appetite to pay at that level to access that consulting from the tech platform. So you might be looking at 50, 100, 200,000. And the real value proposition at that end is, come to us, you get the consultants, we help you prepare this assessment and provide this information. Then you have at the very other end, plenty of carbon calculators where it might be, put in your inputs and here is an average, and it's certainly probably not what you're going to tell the market, the number, but it might be quite fine if you are just internally trying to get a general understanding and you might be just, dipping your toe in this for the first time. And then there's obviously broader ESG platforms that deal with everything from modern slavery, diversity, and everything else that sort of sit over that as well. And so what Sumday said is our clients do not have a willingness to pay at the watershed and the Persephone level, and they also want to have more of an internal understanding around this space rather than just someone else do an annual report and it doesn't really feed into our strategic decision making. And the low end was just too low. So really Sumday's differentiator is, well, we're here to provide as much education and upskilling to that internal team as possible, or to the accounting firms. So we have very strong relationships with the accountants as their preferred accounting software. And from a software or a product perspective, we really say we're just accounting software, except instead of dollars and cents, you're dealing with carbon, and we really see the future as non-financial accounting. So natural capital, biodiversity, social impact accounting, we sort of see a roadmap around that. But for us, it's about having this solid, auditable accounting platform that your CFO is living in and using, or your finance team is using, or your ESG team. It's a product that provides full transparency so that when you go and sit in those meetings and you're asked, where did these numbers come from, you can explain it. And it is an affordable and accessible platform that you can be used and embedded year on year, rather than just one enormous exercise that requires 1,000 approvals to proceed with.
Right. Okay. And then the last one for me, what are some of the Sumday's key milestones and goals over the next 12 to 24 months, so we can keep tabs and see if you guys are executing on your plan?
Absolutely. So for us, the next 12, 24 months is a huge opportunity for organizations, particularly with this compliance stage that we're all entering. And so for us, we want to do a couple of things very well. First, we want every existing, large to mid-tier accounting firm having the skills to be able to provide carbon accounting as a service, as an extension of the traditional or normal accounting work that they're already doing. So that requires us to continue building those relationships, continue upskilling the audit teams and the accounting teams to make this stuff accessible. On the other side, we are starting to work, and it's a focus for the next 12 to 24 months, with those pension funds or banks and investors who are genuinely looking at how their investments have an impact and want to be across this information for a variety of commercial strategic reasons, and really enabling them to empower their portcos to provide this information. And so for us, the focus over the next 12 to 24 months is to go deep through those supply chains and those portcos and demonstrate that when you do provide the education, when you do provide affordable tools, that this data starts to flow. So in the next 12 months, we'll really start to see whether a Sumday customer has got access to better, higher quality data and stronger relationships with their suppliers and portcos as a result of this kind of education first process than what they would have if they did not go down that path.
Well, great. Well, Jess, Lindsay, this has been fantastic. Thanks so much for joining me this afternoon, for me this morning, for you guys. I think I learned a lot. I think it's fascinating. Hopefully our group did as well. So thanks again, and we'll look forward to catching up again soon.
Thanks so much, James. Thanks
Thanks,
everyone
James.
for joining.